The night air over Georgia hums with electricity. Under the glow of endless mining rigs, thousands of machines whir in unison, transforming raw power into digital gold. The metallic hum blends with the pulse of energy, forming a rhythm that never stops. At the heart of this massive electrical symphony stands one company, CleanSpark. Originally, CleanSpark was not a mining company at all. It began as an energy optimization and microgrid technology firm, focusing on systems that generate, store, and distribute power independently of the main grid. These microgrids were designed to make electricity more efficient and resilient, a promising, stable, and sustainable business. But in 2016, CleanSpark made a stunning pivot. It changed its name and stepped into one of the most volatile industries in existence, Bitcoin mining. Normally, this kind of shift would be unthinkable. Energy firms prefer long-term infrastructure projects with predictable returns, while Bitcoin mining is notorious for wild fluctuations tied to the coin's market price. Mining profits rise and fall with Bitcoin's volatility, energy costs, and mining difficulty, a trifecta of instability that scares off most corporate boards. But CleanSpark saw opportunity where others saw chaos. With deep expertise in power efficiency, it believed it could mine more coins per kilowatt hour than competitors. The gamble was simple but audacious. If power is the lifeblood of mining, mastering efficiency could be the ultimate edge. In 2020, CleanSpark began its transformation in earnest by acquiring ATL Data Center in Georgia, establishing its first large-scale mining facility. 2 years later, it bought the Mawson-Sandersville site, adding roughly 80 megawatts of capacity. By 2024, it had acquired 5 additional facilities across Georgia, bringing total capacity beyond 60 megawatts. Expanding that rapidly in such a power-intensive sector is rare. Most mining firms take years to build or secure new sites because they must first negotiate electricity contracts, install advanced cooling systems, and stabilize power distribution. CleanSpark's rapid expansion was possible only because it locked in long-term energy deals ahead of time and executed synchronized procurement of high-efficiency mining equipment. It moved like a logistics company with military precision. Every watt of power accounted for before a single rig was installed. Then came the numbers that shook the mining industry. In spring 2025, CleanSpark's hash rate reached 42.4 exahashes per second, EHS, a record among public miners. By that summer, it broke through 50 EHSs, cementing its position among the global leaders. To put that in perspective, 1 exahash equals a quintillion, tens of machine computations per second. Achieving 50 EHSs means performing 50 quintillion calculations every second, non-stop. Typically, reaching that scale requires multiple years of hardware cycles and capital raises. CleanSpark did it in months. The key was a massive procurement deal for Bitmain S21 miners, some of the most energy-efficient rigs on the market, and the strategic placement of those units in Georgia's low-cost power regions. The company had effectively optimized its cost per hash, converting energy into Bitcoin with unparalleled efficiency. By mid-2025, CleanSpark's treasury held roughly 12,000 Bitcoins, and it was mining hundreds more each month. The company's balance sheet looked strong, yet beneath that strength was a new layer of complexity, one that few investors fully understood. Instead of issuing stock or bonds, CleanSpark raised liquidity through Bitcoin-backed credit facilities. It secured about $200 million from Coinbase Prime and another $100 million from 2Prime, using its Bitcoin reserves as collateral. On paper, this was brilliant. It avoided shareholder dilution and kept the company nimble. But there was a catch, a dangerous one. Bitcoin's price is volatile, and collateralized loans tied to such assets can collapse overnight. If Bitcoin prices fall sharply, lenders can issue margin calls, forcing the company to either pledge more collateral or repay the loan early. In a bull market, this structure amplifies returns. In a bear market, it magnifies risk. Here lies the first major mystery. Despite its aggressive use of Bitcoin-backed financing, CleanSpark has never disclosed its loan-to-value ratios, collateral thresholds, or margin call triggers. Normally, companies provide this information to reassure investors about liquidity stability. CleanSpark's silence raises questions. Is the company's collateral buffer thinner than it appears? Have lenders tightened terms as Bitcoin volatility grows? Or is the company guarding a competitive financing model it doesn't want rivals to copy? The opacity is unusual and potentially revealing. The second mystery appeared just months later. In fall 2025, at the height of its mining success, CleanSpark suddenly announced a major strategic expansion: AI compute data center infrastructure. For a pure-play miner, this move was baffling. Mining and AI computing both demand immense power, but in fundamentally different ways. Bitcoin mining requires steady, consistent power to maximize hash output, while AI workloads, such as training large language models, demand dense, flexible energy and advanced cooling systems. The two workloads compete for the same electricity, but use it differently. Allocating power between them is like splitting one heart between two bodies. Normally, miners never divert power away from hashing. It would hurt production and raise costs. Yet CleanSpark announced that it would begin dedicating part of its energy supply to AI. Why would a mining company jeopardize its core output? Theories abound. One explanation is that CleanSpark sees the AI boom as the next power frontier, a chance to monetize its electrical and infrastructure expertise in a more stable, contract-driven industry. Another possibility is that management fears long-term saturation in the Bitcoin mining market, especially as global difficulty rises and halving events continue to squeeze margins. Diversifying into AI could provide a hedge against mining cyclicality. But here's what's strange. The company hasn't revealed how much of its total energy is being redirected toward AI, not even a percentage. For investors, that's critical data. Power allocation determines profitability, yet CleanSpark's reports group all energy usage under general data operations. This lack of transparency suggests either strategic secrecy or operational uncertainty, both of which deepen the mystery. Then came the leadership twist. In summer 2025, right after breaking the 50 EH/s milestone, CEO Zach Bradford stepped down, and co-founder Matthew Schultz returned as CEO. At the same time, Jeffrey Thomas joined as Senior Vice President of AI Data Centers. Executive changes during periods of record performance are extremely uncommon. Normally, leadership transitions occur amid underperformance or crisis. CleanSpark's timing, right after achieving its greatest success, defied convention. Was this change premeditated, or was there an internal disagreement about the company's direction? Did Bradford's departure coincide with the shift toward AI? Whatever the reason, this move suggested a strategic reorientation at the highest level. Individually, these events might seem coincidental. Together, they form a coherent, yet puzzling narrative. CleanSpark is evolving from a Bitcoin miner into something more hybrid, a company straddling the border between energy and computation. It's no longer just converting electricity into Bitcoin. It's trying to turn electricity into intelligence. But whether this transformation strengthens the company or stretches it too thin remains unclear. Today, the hum of Georgia's mining farms continues. The lights still blaze across the cooling racks, but their purpose is no longer certain. Are they still mining Bitcoin, or are they powering the neurons of an emerging AI infrastructure? Investors are left to wonder which path the company has truly chosen. For investors, CleanSpark's story isn't just about stock price movements. It's about three forces: the flow of power, the stability of collateral, and the intentions of leadership. These elements together define its fundamental value and determine whether CleanSpark becomes a new kind of digital infrastructure powerhouse or a company caught between two worlds. The ValueStir channel invites you to share your insights on any listed, unlisted, or pre-IPO stocks and cryptocurrencies that deserve deeper investigation. Your comment could spark the next story we uncover. Please leave your thoughts below, and if you've enjoyed this analysis, don't forget to watch, subscribe, like, comment, and share this video with others who follow market transformations as closely as you do. Your engagement drives our mission to deliver sharper, more detailed, and more transparent content every week. This was ValueStir.